What if I told you the biggest threats to the stock market right now are the ones that many people are ignoring? These problems may be bigger than you think. Most won't talk about it, but we definitely will. Today, we're going to break down the 6 problems the stock market's currently facing. First, we'll examine inflated valuations to see what history can teach us. Then, we'll dive into the bond market to understand its warnings, explore how money flows are changing in today's market, and discuss inflation's long-term effects. Finally, we'll tackle the looming corporate debt crisis and the case for no Fed rate cuts and what that means for investors. Guys, with that said, the history of the stock market, going back to 1957, the S&P, and going back to 1870 to its equivalents, during very high valuation levels, it takes just a small spark that people were not seeing to cause the biggest problems. I normally wouldn't care about any of these, and for the long term, I don't care. But I'm just trying to use this as a showing you guys that in the room filled with gasoline, we don't know what spark will cause the explosion. But there will be a spark that causes the explosion. And that spark is usually something that people don't see. Again, this does not mean that these problems are going to bury this country. It just means with these valuations and where we stand in the market, with this kind of euphoria, any small thing, any sort of kink in the armor can cause a bigger problem than would normally occur during a normalized market. Now, let's start with valuations, which are often the clearest indicator of where the market might be heading. Now, remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the weight comes from valuations. And as of today, valuations are absolutely off the charts. Those who aren't willing to admit that are ignoring the obvious elephant in the room. Now, if you're a regular to our channel or our other channel, the Everything Money 24/7 channel, every week I basically give a stock market to GDP and a 10-year cyclically adjusted PE ratio recap. I'm going to show this to you right now. The stock market GDP is very simple. It compares the entire stock market's market cap to total GDP. And it makes sense. As GDP goes up, the companies within that GDP should go up with it. There's a lot of criticism of that metric saying, oh, companies earn more abroad, blah, 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 blah. Fine. What's interesting is the 10-year cyclically adjusted PE ratio, the 10-year CAPE, doesn't care where any of the earnings are made. It looks at the S&P 500's last 10 years of earnings, brings it to today in today's dollars using inflation, and gives a PE. So let's compare today to the 1970s during the period of time the U.S. experienced stagflation. The economy was grappling with high inflation and high employment. The S&P 500's price-to-earnings ratio fell to around 7, far below the historical average of 15 to 17, and valuations were grounded in economic reality. Fast forward to 2025, and let me show you these valuations. The stock market GDP ratio is 111% over his historical average going back to 1929. The 10-year cyclically adjusted PE ratio is even worse, 121% over the historical average. And these are largely fueled by a handful of large tech companies. It's like building a skyscraper on shaky foundation. So what's the lesson here? Valuations this high leave no room for error. But keep in mind, we've had high valuations for quite some time. And there was an AI boom that really spurred a lot of dominance, and a lot of people went to these stocks and drove prices higher. Now, back in 2000 during the dot-com bubble, it felt a lot like today. These companies couldn't do any wrong. The internet was changing the world. But guess what? We still had 98 or 99% of these internet companies go bust. There was tons of hype. The S&P's price-to-sales ratio was 2.3. The stock market GDP ratio, we're currently at 111% overvalued. Guys, here's what's scary. Going back to 2000, March of 2000 was the peak. We were at 55% overvalued. We're exactly over double that today. The 10-year PE, though, that was a little bit different. Back then, the 10-year PE got a lot worse than it is today. So you might be thinking like, oh, there's plenty of time here. But back then, we were in the 40s. We're currently at 38. We were in the low 40s, hitting a peak of 44.19. Now, let's turn to the bond market. The yield curve inversion has been a remarkably accurate recession predictor for a long time. Historically, when the 2-year Treasury yield surpasses the 10-year, a recession usually follows within 12 months on average. But in 2022 and 2023, something strange happened. The inversion lasted for 15 months, longer than ever before. And guys, I've talked about this before in other videos. Did we have our first soft landing? I don't know. We always look at recessions in hindsight, but it sure feels like that. So guys, this is the history going back to the mid-70s. This is where the inversion happens, below this. And look at the past. Yes, we had major recession here. We had a recession here. We had a recession here. By the way, this isn't called all recessions, but when it does go down, these are the recessions thereafter. There was a slight recession right here, which they don't really, it was such a small recession, but look at these inversions. Slight inversion here right before COVID, but we don't see a recession right here. So do we have our first one? I don't know. But these are still things that matter. Why it matters is when the 2-year inverts over the 10-year, what that means is people see more risk in the short run, and that's why they want more interest versus a 10-year. Because usually when you borrow money for a longer period of time, you need more interest to cover the probability of something bad happening in that long period of time. Let's talk about how money flows in today's market, because the rules have definitely changed. Passive funds like ETFs have absolutely changed the game when it comes to investing. They now control over 40% of US equity assets. For example, the dominance of Apple, Microsoft, and indices like the S&P 500 has been amplified by passive flows into these funds, driving their valuations higher regardless of fundamentals. And the reason being is, as people dollar cost average into these things, like we preach all the time, the people who operate these funds are forced to buy more of those companies, therefore driving up the price. As the price drives up, people have FOMO and they want to invest more in the market. This creates a feedback loop where the biggest names get even bigger. As of recently, we hit a massive all-time high of the top 10 stocks in the S&P 500 accounting for 40% of its value. Historically, the average is between 15 and 20%. That's an unbelievable difference. It means this market's very, very top heavy, which is something very similar to what happened in 2000. We saw a lot of top heavy companies. Now, you guys have probably all heard about algorithmic trading. Algorithms now handle over 50% of daily trading volume. They move faster than any human ever could, but they also amplify volatility. Remember that 2010 flash crash? I remember where I was. I was on the golf course playing golf, and somebody messaged me and said, holy crap, the Dow just plummeted. And by the time I pulled it up, it was right back up. That was a case of algorithms gone wild. The big crash in 1987, even though it was the very early stages of algorithms, that was caused by algorithms as well. Because once that certain trigger happened, everybody started selling, and that caused the massive plummet. So in a market dominated by passive flows and silicon brains, finding undervalued opportunities can feel like it's harder, but it's not impossible. Ignore the noise and focus on companies with strong fundamentals. These are the opportunities that algorithms and passive funds will often miss. Now, don't get me wrong. I'm actually a big believer, as I've said to you before, about dollar cost averaging and even algorithmic trading. But if you want to understand companies, a computer will not do that for you. You have to do that on your own. Now, we've explored valuations, yields, and the way money flows. But there's a larger force at play here, inflation. It's not just a backdrop, it's reshaping every part of the market, and everybody has their focus on it. It's not just a buzzword, it's a game changer. Post-pandemic, inflation reached a high of 9%, the highest in 40 years. From 2000 till that point of 2022, 2023, inflation was averaging like 2% a year. And even though it's cooled by now, the forces that drive it, like reshoring, rising labor costs, and geopolitical tensions, are going to be here to stay. We've had these issues for a long time. We will continue to have these issues for a very long time. In the 1970s, inflation wreaked havoc until the Fed raised rates aggressively. Globalization, which has kept costs low for decades, is evolving. Supply chains are moving closer to home as companies and countries become way more profitable overseas and they have to pay people more. And on top of that, you have clean energy initiatives that are adding costs to production. Yes, there's a benefit to the environment, but anybody who thinks that doesn't add costs is living in a world of delusion. Now remember, in the long run, inflation, as long as it's understood and consistent, doesn't hurt or help the market. In fact, it can help you, especially in real estate and stocks. It's the massive jumps and drops of inflation that really, really scare people. Somebody that takes a year to get a raise, but they see a 9% jump in a matter of months, that's going to affect their pocketbook. That's why you saw credit card balances jump up so much as prices increase, because people still had to keep their lifestyle going while making the same amount of money, even though costs had skyrocketed. Now, from an economic perspective, the debt maturity wall is coming. This is a challenge that could define the financial landscape in 2025. Guys, how big is this debt? $1.15 trillion. That's a big number. That's how much corporate debt is maturing in 2025. Now remember, back when rates were zero, corporations could borrow at 3 or 4%. As rates go to 5%, let me ask you this question. If you can get 4.5% in your bank account, would you ever buy a corporate bond for 3%? Of course not. And of course, speculative grade debt will outpace investment grade debt all day. Companies that issue debt at rock bottom rates will now face much higher refinancing costs that will also affect their bottom line. Look at any company out there, their interest costs keep rising. For some companies, the ones without great balance sheets, this will be a breaking point. Commercial real estate is particularly vulnerable with $1 trillion maturing this year and office spaces having struggled, but seeing a slight turnaround. You're going to have to expect some turbulence there. So what should you look for? Keep an eye on companies with strong cash flow and manageable debt. It's one of our pillars for a reason. We want to make sure that when you analyze a company, their cash flow in the last 5 years can easily support the debt the company has. That way, if rates go, it's just a temporary decrease in their profitability and cash flow. And when the weak falter, disciplined investors and disciplined companies can find great advantages for their business and for the investor in finding great companies at great prices. And finally, speaking of these rates, the problem that's been moving the market over the past few weeks has been these interest rate cuts. In 2024, the market was pricing in 7 rate cuts. I remember December of 23 making videos where everybody was saying the expectation was 7 cuts. Inflation had been cooling, unemployment was low, and investors were excited to invest in stocks. But then Jerome Powell and the Fed only cut rates 3 times for a total of 1%. So guys, we had 3 cuts going from basically 5.5 down to 4.5 or so because we did a full 1-point cut. One rate cut was 0.25, another one was 0.5, another one was 0.25 for around 1%. Now remember, they give ranges, so I'm giving the recap here. But this is where we stood. But remember, it's a far cry from where everybody thought we'd be. So you might be thinking, if these 6 problems existed in 2024, why did the markets continue to climb and have one of the best years in the last decade? Well, companies, especially in tech and AI, kept defying the odds, posting strong profits and driving the price of these indexes. Central banks outside the US were loosening up, keeping cash flowing worldwide. And of course, the ultimate FOMO, fear of missing out, drove investors back into growth stocks, pushing prices higher and higher. The soft landing fantasy gained traction, making investors believe the Fed could balance inflation control with economic growth. It's yet to be seen. All indications to me say, yeah, it's happened. But of course, I'm one of those guys who says it's not different this time. Here's the truth though, guys. Pricing in 7 cuts was never a certainty. It was a hope that was spun by the markets to focus on short-term gains. It didn't end up happening, but this year they're factoring in 1 cut. Maybe they're raising rates. We don't know. That's what we're trying to teach in principle-driven investing, that you're not going to make these decisions based on short-term decisions that don't matter in the long run. Crashes and bear markets are not created by things we expect. They're created by the unexpected. So if you've been spoiled by the last 5, 10, 15 years, it's okay. I was spoiled 25 years ago during the tech boom and the dot-com boom. And you learn these lessons and it makes you better because of it. And when we do finally have a future recession and stock market correction, it will be amazing opportunities for you. Just remember, every investment is a present value of all future cash flows. And when you're buying a stock, you're buying a piece of a business. These are 2 foundational pillars of our principle-driven investing. If you remember that, you will do very well long-term. But if you remember that now, you're going to feel left out. That's what makes it difficult about being an investor, is going against the grain. The thing I didn't realize 25 years ago was that when we have a bear market and even a crash, it's an amazing time to invest. From the peak of 2000 to the bottom of 2003, the NASDAQ 100, which you can buy through an ETF called QQQ, fell 83%. 83%. Guys, here's the amazing part though. If you started dollar cost averaging at the peak, before it fell 83% to today, you would have gained over 15% annualized return. Even stomaching an 83% drop and waiting 15 years for the NASDAQ to get back to its all-time high from 2000. We didn't hit that till around 2015. But the interesting part is that dollar cost averaging of over 15% happened even though QQQ has only done between 7 and 8% since 2000. Now, of course, I want you to pick individual stocks if it's right for your portfolio and for your mentality, but you first need to focus on getting your goals situated with dollar cost averaging. I'm trying to teach you principle-driven investing. Avoid the hype. Avoid the junk companies with bad balance sheets that are just seeing the prices go up. It's about buying good companies at the right price. If you're not doing that, you're speculating. We need to combine a story with the numbers to make successful investments. Because a story by itself is a fairy tale, the numbers by itself is just an Excel sheet. If this makes sense to you, you're at the right place and it'll always be better in the long run. The question is, what will you do when the market does correct? Here's what most people do when markets fail. They panic. I have 1,000 stories about this, and it's even scary to me now when I hear friends saying, well, if stocks fell in half, I'd be fine. I'd buy more. Guys, I've heard that every single time, and guess what happens? When it does happen, they say, yeah, but look, what we didn't know was, look how bad the world looks here. I would have bought more, but the world looks bad. Yet if we look back at the times when stocks did fall a ton, there was always a bad story about the world. And the people who made the most money were the ones that still bought. Guy Spear wrote one of the best books ever called The Education of a Value Investor, in which his value investing friends gave up. When they said they were value investors and prices fell, they gave up. And he would say, but this is what we always talked about we were waiting for. They said, well, no, I can't take these losses. It's different this time. The news is this. Well, guess what, guys? It's not different now, and it won't be different then. They sell their stocks at a loss. They quit investing entirely. They blame the system. They blame news. They state things like the market is rigged. You understand the warning signs and the mistakes most people make when markets do fail. But there's good news. You don't have to go through this alone. And this is exactly why we created everythingmoney.com. When the next crash happens, and it will, you'll need the right tools and mindset and support to turn that into the opportunity that it's meant to be. And that's what you get here in our community. All these tools up here are the tools I use every single day to analyze stocks and buy real estate, opportunities, and to use it to make less mistakes. We have a group of like-minded investors who keep buying when everyone else is panicking and have the confidence to make smart decisions when the market is falling. This community of thousands of like-minded investors talk every single day. And the best part is, when markets are red, that's when the activity and the excitement is the highest. That's the kind of people you need around you. And right now, you can join that for $7 for 7 days. Click the link in the description below or go to everythingmoney.com/signup. Join today because the next market crash absolutely will happen. The question is, will you be ready to take advantage of it? Thank you for your time.